Good morning. Welcome to the Plato Income Maximiser Shareholders Conference. Your host today is Dr. Don Hamson, Company Director and Managing Director, Plato Investment Management. Go ahead. Thanks, Don.
Thank you, and good morning, shareholders, or fellow shareholders, I should say. Today I'll give you an update on the performance of Plato Income Maximiser, or for short PL8. We'll talk about investment strategy, a bit of an update on ourselves. There's been a couple of developments at Plato since we've listed the company last year. We'll look at the investment environment, which has been pretty challenging for income investing. And then we'll have time for questions at the end if shareholders have questions. So turning to page 4, in terms of investment performance of the underlying investment portfolio of PL8, or Plato Income Maximiser. For the year ending 30th of June, our investment returned 13.3%, including franking credits. This is after fees, compared to the benchmark S&P 200 index, which, including franking credits, that's a tax-exempt index, recorded 14.6. So we were a little bit behind the index, 1.3, and actually similar numbers on an inception basis from essentially the end of April, which is when we first started investing the fund, the proceeds of the listing last year. So we're a little bit behind in that environment, but as I'll talk about later, it has been a very challenging environment for typical income stocks in Australia, and I think we're all aware of the tough time that banks and Telstra have had over the last 12 to 18 months, and we'll talk about that a little later. From a longer-term perspective, moving on to page 5, you can actually see that the underlying portfolio, because the PL8 actually invests into the Plato Australian Shares Income Fund, which has been investing since September 2011, that the Plato Australian Shares Income Fund, the underlying investments, have consistently outperformed the market over that longer term, but have had a slight headwind or a strong headwind on income stocks in the last 12 to 18 months. But importantly, and one of our objectives is income, on page 6 you can see that the underlying investments did accrue, and I'll say these are the underlying investments, so it doesn't reflect the dividends paid by PL8, but the actual investments generated about 8.7% income. This is, in fact, after fees, but that it was 6.3% cash dividends and about 2.4% of franking credits during the financial year that's just done. Now, this is the income that has been accrued by the underlying investments. It is not the actual dividends that were paid. PL8 only commenced paying dividends in October, so only paid 9 months worth of dividends, whereas we are now looking at the underlying investments, how much income they generated over the full 12 months. And you can see that 8.7, when you add up gross up for franking, compares pretty favourably with the yield of the S&P 200, which, including franking, generated 5.7%, or if you just look at the cash yield of the market last year, was 4.3. So we've certainly achieved our investment objective of generating more income. You know, we had to build up some of that income. Being a new company, we had to build up a kitty of dividends really before we started paying those dividends, and we commenced those in October last year. And indeed, on page 7 you can see actually talks about that. We started paying dividends of 0.45 cents per share in October 2017, and then in April the board increased those dividends to ½ cent a share, so it was an 11% increase. And the board has also announced and already paid 2 dividends so far this financial year of ½ cent a share, and there's another one due at the end of this month to be paid. So, you know, we're now paying those levels of dividends. In terms of the financial year ending 2018, the 5 dividends, or 9 monthly dividends that were paid, equates to about a 5.5% yield, just over 9 months, and that's almost the same as what the index got over a full 12 months. If we actually look at the current dividend that's being paid, which is 0.5 cents a share, then depending on which day you calculate the yield, if you use yesterday's closing share price, actually on a fully grossed up basis, that actually now equates to about an 8.2% yield on PL8, if the company continues to pay ½ cent a share fully franked dividends for the rest of the year, which I don't see why we shouldn't be doing that, but the board needs to make those decisions. But you can see that the dividends are now coming out on a regular monthly basis. Moving to the NTA performance on page 8, the NTA performance is slightly different because from accounting rules, NTA doesn't include the value of franking credits, which themselves are quite valuable for many Australian investors. From an NTA basis, we added about 10.5 cents in NTA from our portfolio performance, so that's less than the gross return including franking, because we're not including those franking credits. There's virtually no tax provided for the year because basically all our income is fully franked. There were some tiny company expenses, and then we paid, on a cash basis, because again we don't include franking. We paid those 9 monthly dividends, worked out to be 4.2 cents in financial year 2018, just completed, and that means that the NTA of the company, I'm pleased to say, grew from $1.03.8 to $1.09.9 at the end of June, which is about 6 cents lower than where the company is currently trading. So actually the company is trading cheap on an NTA basis. You can actually buy those assets about 5 to 6% cheaper than what they're actually valued at. And we'll mention a little bit the reasons why we think that's the case in a minute. Now moving to an update, a very quick update on the manager, which is Plato Investment Management, of which I am the managing director. Plato hasn't had any significant changes since we listed, but in terms of updating a couple of things that were talked about in the prospectus, we have added 2 more people to our investment team since we first listed this company. Both very experienced people, and the most experienced and most senior person that we've added is a fellow called Dr. David Allen. He comes to us or joins us from JP Morgan Asset Management in London. He is actually an Australian and has come back home to Australia, but he's got 16 years investment experience. PhD from Cambridge in sort of portfolio construction, ran Dividend Opportunities Fund over with JP Morgan Asset Management, as well as a number of other funds, and he's a very experienced investor, which we welcome to the team, and he's already added some strong research capabilities to the team this year. We are, of course, supported by the Pinnacle Investment Group, and that group continues to grow and add more sort of sister companies like ourselves. Pinnacle's assets under management grew to something like 38 billion, which is a significant increase since the time of listing of PL8. And Plato itself, so Plato Investment Management, has also increased its assets under management. At the 30th of June, we had 4.9 billion assets under management, which compares fairly well with the 3.5 billion we had that was discussed in the prospectus last year. And the underlying Plato Australian Shares Income Fund, particularly when you add in the investments that have come via this LIC, via PL8, has now had assets under management of 1.56 billion at the end of June this year. So that's the main sort of update for Plato. I'd now like to spend most of the time really, I suppose, looking at the investment environment, which has been, say, quite challenging, I think, for income investment, and indeed income is still, particularly in many classic income asset classes, hard to find. Turning to page 12, if we look at the interest rate outlook, it is still very benign. I mean, yesterday, for I think the 25th month, the RBA continued to leave rates on hold at 1.5%. That's been the longest period of time rates have been left on hold in the memory of central bank sort of fixing the interest rates here in Australia, and at a record low level. 1.5% is not a high level of income. Indeed, if you have $100,000, that means invested, you're only going to get $1,500 interest. So that's not a great place to look for income. And the market's expectation actually is that interest rates aren't going up very fast. These are now forecast on slide 12. They are basically the market's expectations, which we've backed out of the Bloomberg sort of interest rate yield curve. And the market is really only expecting maybe 3 interest rate rises over the next 5 years, and that's 25 basis point interest rate rises. So it could be, if that's correct, that by 2023, interest rates in Australia are only like 2.25%. In fact, a well-respected economist, Bill Evans, I used to work with Bill many years ago at Westpac, recently announced that he didn't expect there would be any interest rate rises here in Australia for at least 2 years. So he's sort of looking at 2020 or even 2021 before we have even the first rise by the RBA. I'm not saying that's going to happen, but it does suggest that the interest rate outlook is fairly subdued. The other thing to note from this slide is that US interest rates are now above Australian interest rates. They've been that way pretty much all this year, and it's been the first time for nearly 2 decades that that has been the case, and that I think is one of the factors which is weighing down the Australian dollar. US interest rates obviously higher than Australian, so from a carry point of view, if you're looking to get higher rates of return, you actually get higher interest rates in the US than you can in Australia, and so that is meaning that some money is moving from Australia to the US to get those higher rates of interest. Interestingly, in both Australia and the US, long bond yields are still above cash rates or short-term rates, and I think that's important because historically, certainly post-World War II, every single major recession has been preceded by short rates being above long bond yields, and we still have another % or so in the US before that is a situation. So right at this moment, I'm not predicting a recession anytime soon, based on that sort of indicator. But what this slide does mean is that you're not going to get a great return out of term deposits anytime soon. You're still probably lucky to get 2.5%, which isn't a great return. Moving now to the share market on slide 13, we think this is quite an interesting slide. It shows a couple of things. I mean, the pie chart shows on the left-hand side of slide 13 shows the Australian market is pretty concentrated, very concentrated actually. Surprisingly, or interestingly, 6 stocks in the ASX 200 represent half of the income of the whole ASX 200 index. So there's 200 stocks in that index, but 6 of those stocks provide half of the dividend income. And those are 4 big banks, Telstra and at the moment BHP, although Telstra potentially might be in the top 6 if we do this slide next year. So very concentrated, and remember the 4 banks are all in one sector and they're all right at the moment a bit challenged with the Royal Commission. They were hit last year with the slug of a bank levy by the government. Banks have been doing it tough, and on the right-hand side we've got a slide of the price performance. An average price performance of the big 4 banks is in light blue. The market itself, the ASX 200, is in dark blue, almost black, and the red line is the share price performance of Telstra to the end of June. And clearly you can see that the banks have been doing it pretty tough. Their performance is nearly 20% below what the average market stock has done over the last, it's actually an 18-month slide. But Telstra is down nearly 50% over that time period, although it has had a little bounce back in the last month or so when TPG has announced that it's no longer there's not going to be 4 mobile networks in Australia, there'll only be 3, with TPG looking to merge with Vodafone. That's been a bit of a relief rally in Telstra, but not much more. But you think about those 5 big stocks, they're half the income of the whole market, so if you're looking for income, you're going to be invested in those stocks for sure, have some of your investments in there, and they've had horrible share price performance relative to the rest of the market. So it has been a very tough period for income investors. So whilst we're not happy with our slight underperformance of the market, and you started this discussion saying we're 1.3% behind the market over the last 12 months, relative to investments in the banks and Telstra, we've actually done a lot better. And I think that is actually one of the benefits and one of the motivations for PL8 and the underlying Australian Shares Income Fund is you're investing in a diversified portfolio of about 100 stocks, which still generates a level of income which is probably equivalent to, if not more, than what you get out of the banks and Telstra. And so you're getting the benefits of a well-diversified portfolio, but still getting the high levels of income that you would get if you just had a couple of bank names. But given the bank share price performance, you're significantly ahead if you had been in the Plato Australian Shares Income Fund or the portfolio that we have. So it has been a tough time. And there has been other issues. On slide 14, we saw, and we think this is one of the reasons why PL8 is actually trading down a little bit below NTA, because the ALP announced in March this year that their policy for the next election will be to deny franking credits to many Australian individuals. Charities and foundations are okay. They backpedaled a bit and said pensioners can get franking credits, but there will be no refund of franking credits for other investors in Australia. You can still get a franking credit and offset it against tax payable, but you won't get a net refund of franking credits if you say in a self-managed super fund which is in pension phase. So we don't think this is great policy, and we're doing our best to talk to the various players to put forward the views of our shareholders. I think most of our shareholders like the value of franking credits. They understand them, and it helps them get a better retirement or a better lifestyle. I would advise people not to panic yet. This is the proposal of the opposition. Whilst the events of the last couple of weeks might mean that they're more likely to become the next government, they still have to win the election. Still some water under the bridge there. But not only do they need to win the election, they also need to pass this proposal through the Senate. And whilst there's a reasonable chance they will get a majority in the House of Representatives, I don't think they'll have enough control of the Senate to be able to pass legislation themselves, so they will be relying upon the crossbench senators, and I think it will be much harder to get their approval of this, or dare I say, quite divisive policy and quite, I believe, negative policy. So I think it'll be harder to get the crossbench Senate support, and we will certainly be doing our best to educate those senators on why this is not great policy. But what we would encourage all shareholders to do, if you do agree with us and agree that franking is very valuable, we would certainly encourage you to go to our website and join our petition at www.plato.com.au/petition, or if you actually just go to the central website, you'll see the petition there. That's on slide 15. So moving more quickly into our process, and how have we been able to do pretty well in an environment where the banks and Telstra have had pretty abysmal performance. If you look at the way that we manage shares on slide 16, we actively trade or rotate through stocks to capture income, to capture those important franking credits, and to capture what we call run-up, or the tendency for stocks to actually outperform or perform quite strongly before they go ex-dividend. But underlying that, we also have a portfolio of good value shares, high quality shares, and stocks with good business momentum. But also importantly, if you're focusing on income, you also want to try and avoid the dividend traps. And by actively rotating through stocks, the beauty, or the, I suppose, uniqueness of our process is we don't need to be overweight banks to generate a high level of income. We certainly do buy the banks to get their income, but we're not overweight all the banks all the time. And I think a lot of income strategies, that's what they are. They're overweight the banks and Telstra because they are very high yielding stocks and liquid stocks, but they sit there all year, and if that was the case, you would have very, very poor performance, and we would have a much poorer story to tell you. But by moving in and out of banks and between banks, and we were overweight CommBank last month, and it paid a decent dividend, actually slight 1 cent increase in that dividend. But now we've reduced our exposure. Similarly, we're about index weight in Telstra. It hasn't been our favourite stock. It has been challenged, but we did go in to get some dividend out of Telstra, but we've now moved to an underweight position. So we rotate through. And indeed, this is sort of the commentary on page 17. It has been poor performance for those banks and Telstra, but by moving and actively trading, we haven't had nearly as bad a performance as someone who was just overweight those. Clearly, we know the reasons why the banks have underperformed. So the levy, the bank bashing, the Royal Commission, etc., hasn't been positive. Hasn't been positive environment for many financial service stocks. We've also been underweight the likes of AMP because clearly it has had its challenges. But on the flip side, if the income stocks have underperformed, what has outperformed in the last 12 months? Why has the market been quite as strong as it has when such a large part of the market has had a tough performance? Well, the really standout performers in the last 12 months are certainly not income stocks. They're more growth stocks, or they're stocks that have really, I suppose, coming back from quite poor environments. So, I mean, standout performer in the last financial year was A2 Milk. Doesn't pay a dividend, up 180%. So that was a great performer, but it's not likely to be a stock that you buy for income purposes. So we haven't held that stock, nor have we held Origin and Santos. And whilst Santos has reinstated a dividend, didn't pay a dividend in the last financial year. We didn't own it, but it did have a strong recovery. But that was sort of a rebound from a completely oversold position, and a tough position it was. We had some holdings in Telstra, but not as much as we may have had previously. Telstra's dividend did take about 12 basis points off the market's yield, but it's interesting that increases in dividends from the likes of BHP and Rio, which we have been actively rotating in fairly aggressively, have more than made up for the Telstra cut. So people shouldn't be worried about the outlook for dividend income for the Australian market. We still expect that dividend income to be quite strong. In fact, in the recent reporting results post 30th of June, you saw the likes of Magellan do a large increase in its dividend. And indeed, I think on the stronger news, if you actually look at the second half of the financial year, so the first 6 months of calendar 2018, our performance actually we outperformed. So we underperformed particularly in 2017 calendar year, but we have outperformed at least pre-fees and post-fees in the first half of calendar 2018. Stocks that were particularly strong for us were stocks like Macquarie and IAG. As I mentioned before, we basically didn't hold AMP, which has been a good one to avoid. And we got some good performance out of a number of resource stocks that we also held in the portfolio, as well as stocks like Qantas and BlueScope Steel. We were still, though, underweight or not owning stocks like CSL and A2 Milk, although we do actually have a holding of CSL, but it's very hard to be overweight a very low-yielding stock like CSL when you have an income objective in a portfolio. So, yeah, it wasn't the greatest year for us, although we still think that the total return was good. The PL8 itself did trade a bit below NTA. We think a couple of reasons for that. One was, I think the notion of, income stocks have underperformed. So I think people say, well, it's an income, portfolio, so it's probably had poor performance. Well, our performance hasn't been that poor, just a little bit under the index. But I think the ALP proposal did also cause a bit of softness in the share price, and if you can join that petition, hopefully that we might see that thing go away, or at least be significantly watered down before it ever sees legislation. So look, that was pretty much it for me. We have a few minutes for questions, so I just wonder whether there are any shareholders on the call who would like to ask questions.
Okay, thank you, Don. I'll take over now, and that's a *1 on your phone if you would like to come into the queue to ask a question. So *1 on your phone. Thank you. Okay, I have a question from Rule Salter. Go ahead, please.
Yeah, hi. Look, mine was more of a request rather than a question. I note we're very pleased to be receiving the monthly dividends and appreciate that. Is there an intention to stop sending in the mail confirmation of those dividends and just sending them via electronic medium, because we're getting them both ways, and I just think it's obviously from a cost perspective and also from a concern in relation to the environment, receiving them each month I think is a bit of a waste.
Yeah, look, I'll definitely check that out. I know I'm an investor as well, and I only receive them all electronically, so we will talk with the administrator, which is Boardroom, who look after those things, to make sure that if you're getting it electronically, you shouldn't get it via paper. And in fact, for any other shareholder, we would encourage you to elect to receive these things electronically, because it's good for the environment, but it's also good for all our shareholders, because there is a cost associated with mailing out these things. So we'll follow that one up with Boardroom and see if why you're getting it both ways.
Thank you.
Thank you. Our next question is from Darren Lefter from CommSec. Go ahead, thanks, Darren.
Good morning. Just wondering if there are any plans to actually take any action around the discount to NAV, particularly, or at what level you might do it. There seems to be a few LICs trading at discounts at the moment, one of which WD just got a takeover proposal from WAM. So just wondering if that's a concern for you at this point in time.
Look, we'd certainly like it to prefer it to be trading at or slightly above NTA, but I think the current level of discount is not significant. So at this stage, directors haven't determined to do any detailed plans to, buy back or what have you. I mean, one of the things that I thought it might be a question around is that, we've accrued 8.7%, or the underlying investments have accrued 8.7% income or dividends, gross dividends during the year. We've paid out less than that. So there is, if you do the mathematics, I'm not telling you anything that's not there, but if you're paying out less than you're earning, then there is potential to potentially increase that dividend going forward, which would be, I think, a positive signal. But directors may look at other issues, particularly if that discount increases.
And just on the fund size itself, is there a critical mass that you're looking at in terms of when the strategy sort of tops out in terms of fund size?
Yeah, so one of the things that we did, we have actually, we think that we can run maybe $2 billion absolute max in this strategy at current market level. So we raised the underlying Plato Australian Shares Income Fund, we raised the minimum investment to $100,000. So that has slowed inflows into that. So in fact, our current total strategy, I said, is about $1.5 billion. We're now at the stage that essentially our inflows into the underlying portfolio are equal to about what we pay out in distributions and dividends. So we're actually at a steady state, which is a good state for us. We don't want to grow the strategy too much, because I think the problem with many fund managers or what have you is they have a great strategy, they get a lot of money in, but they get too much money in and then they can't perform. We want to, we're happy with the funds we have, and that's why we lifted that minimum.
Thank you.
Doesn't affect PL8, of course, because PL8 is a traded company.
Thank you. Our next question is from Justin Wine from Comset. Go ahead. Thanks, Justin.
Just a quick question around updating the market. Do you intend to increase the frequency by which you're providing NTAs? Currently, the monthly one is a bit dated by the time it arrives, and I notice the underlying gives daily on the website.
Yes, look, the directors, we have discussed potentially increasing the frequency of the NTA announcement. I think we'd probably initially move to a weekly if that were the case, so that is certainly something the directors are actively discussing.
Okay, thank you. Our next question is from Mark Simmons from Peak Fin. Go ahead, thanks, Mark.
Yes, Mark Simmons. I was just wondering, is there any thought or consideration being given to having a market maker in the shares so that the shares would trade at the tangible asset backing or near there, like some other funds, some other managed funds?
Yes, so the market maker is usually happens for what are called ETFs, so exchange traded funds. So this is actually a listed investment company rather than exchange traded fund. So yeah, it's not really appropriate to have a market maker in a listed investment company. So as we talked about before, other areas for trying to get the thing closer to NTA would be to potentially look at increasing dividends, doing buybacks, or that sort of nature. So yeah, the market makers is usually for ETFs or ETMFs.
Okay. Thank you.
Okay, thank you. We don't have any further questions.
All right. Well, I'd just like to thank everyone for listening. Thank you, shareholders, and happy to receive your questions and feedback, and we'll certainly look into that statement issue. So thanks everyone, and have a good day.